Ladies and gentlemen, good day and welcome to the Q5 FY13 earning conference call of Escorts Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Raghvendra Jaipuria from Perfect Relations. Thank you, and over to you, sir.
Thank you, Karuna. Good morning, and thank you for joining us on Escorts Limited Q5 and 15 months FY13 results conference call. Today we have with us Escorts Limited senior management, represented by Mr. Sridhar, CEO Agri Machinery, Mr. Murthy, CEO Construction Equipment, Mr. Dipankar Ghosh, Business Head Railway Products, Mr. Lalit Pahwa, CEO Auto Products, Mr. Rajiv Das, VP Corporate Affairs and Communication, Mr. Bharat Madan, CFO, Ms. Jyoti Khatuka, Head Treasury, and Mr. Saikat Mukhopadhyay, CFO Construction Equipment. We will start the call with brief opening remarks from the management, followed by an interactive Q&A session. Before we start, I would like to add that some of the statements that we make in today's call will be forward-looking in nature. At this moment, I would request Mr. Das to make his opening remarks.
Ladies and gentlemen, shall I start? Ladies and gentlemen, a very good morning to everyone and greetings from Escorts on the new year. As you are all aware, Escorts Limited has extended its financial year by 6 months, that is up to 31st March 2014, as approved by the Board of Directors in their meeting held on the 2nd of October 2013. The results reported yesterday of our Q5 and Q15 ended 31st December 2013. This quarter, Escorts has delivered significant results on the back of strong customer-focused product strategy, operational efficiency, cost rationalization, and sales growth. Let me give you a small snapshot of the quarter ended December 2013. Tractor volumes up at 19,047, and they are up by 28.3% sequentially and 11.35% correspondingly. Construction equipment at 737 units, up by 11.5% sequentially. Our operating income increased to 1,159.6 crore, whereas our EBITDA up by 34% to rupees 71 crore as compared to rupees 53 crores last year. Finance cost down by 5.9 crores to 15.9 crores. Profit before tax, PBT, up by 82% to rupees 56.8 crore as that of rupees 31.2 crore last year, same quarter. Let me turn my attention to our performance on a 15-month basis ended 31st December 2013. Tractor volumes increased by 9.6% to 85,277. Construction equipment volume stood at 4,112. Our operating income rose by 7.9% to rupees 5,308.6 crores, whereas our EBITDA increased 42.6% to 335.5 crores and now stands at 6.3%. Finance cost down by 21 crores to 97 crores. Group PBT more than doubled to rupees 239.8 crores, and PAT increased by a similar multiple in 15 months ended to rupees 213.1 crore. I will now turn our attention, and starting with Agri Machinery division, we look at the division-wise performance. Last 15 months, the tractor industry has grown by about 14%, with strong growth coming in from South and West markets. We see the trend to continue, and in the 18-month cycle, which will complete by March 2014, the industry should show a similar cumulative growth in the range of 14 to 15%. We did well to capture volume growth in line to industry without compromising on margins. Tractor volumes went sequentially up by 28.3% to 19,047 tractors in Q5, as compared to 14,842 tractors in Q4, which is September 2013. During same period, domestic industry grew by 25% and we grew by 28.3%. With customer focus, improved product mix and volume increase, the EBIT for the quarter increased to 92 crores and margins at 9.4%. In order to expand our reach to customers, Escorts has continued to expand its dealer footprint across the country, focusing on the profitable strategy and keeping our focus on growth through profits. Company took price hike in November last quarter. This quarter, Agri Machinery Division made inroads in the European market with the launch of its Europe line and Heritage Series tractors in Hanover in November with its global brand Farmtrac. And with it, it brings a stunning mix of Indian engineering excellence and world-class engines and designs. These products are aimed at a revolution in the underserved small HP farm market through its world-class competitively priced products. This range of products will be accompanied by further strengthening of its higher HP range of European Farmtrac tractors. In yet another development, the company recently launched its new PowerTrack Euro Series, offering European comfort and stylish features for the new age Indian farmers. The new PowerTrack Diesel Saver DS Plus Euro Series offer increased comfort and pleasant environment for more work and more earning opportunity for the Indian farmers. The Indian farmer today wants and does work for long hours and therefore requires a driver-oriented tractors with comfort, seating and feature which the PowerTrack DS Plus Euro Series meets the requirement. Turning to the Construction Equipment Division. The industry is facing challenges from various issues of the Indian economy, including lower GDP growth, delays in clearances of projects and long-term finance-related issues. Infrastructure project and expansion plans are stalled for reasons from problems with land acquisition to tardy clearances of projects to non-availability of finance. Delays in clearance and uncertainty in implementation only means that it will take some more time before the industry shows signs of revival. At Escorts Construction Equipment business, we are working at product enrichment and lean manufacturing, and with this approach in mind, we reduced our break-even point by a fair margin, mainly through fixed cost rationalization. The revenues during the quarter saw a growth of 12.6% versus last quarter, and there was a positive swing of 212 basis points at EBIT level from the last quarter. We sold 737 units this quarter versus 661 units in the last quarter. On a corresponding basis, even though we sold approximately 150 machines less, the turnover has been flat, but a positive swing of 310 BPS at the EBIT level. We will continue to shift and move and take initiative towards a better product mix, leaner manufacturing, improve our sales reach, and better management of fixed costs to overcome the tough times ahead. Moving to the Auto Product Division. The Indian automobile industry is witnessing continued pressure owing to sustained deceleration in economic activity and consequent weakness in consumer and business sentiment. High inflation, fuel prices and interest rates have resulted in a decline in annual car sales for the first time after 2002. Car sales in India have witnessed muted growth for only 3 of the past 17 months and a degrowth for the remaining part. Commercial vehicles are badly hurt due to lack of mining activities and stalled infrastructure projects. In the last 5 years, the Indian auto component industry witnessed the slowest revenue growth in 2012-2013 as suppliers faced weak demand from domestic automobile companies, sluggish exports, and tepid replacement market sales. The sector is expected to witness improvement from the second half of 2014 with a likely fall in interest rates and deferred purchases materializing into better sales. Also, industrial activity and infrastructure spending are expected to pick up. However, increasing competition is likely to keep margins under pressure in the auto and auto component industry. Escorts Auto Products continues to face challenges in the current environment, and we are disappointed by the performance. Fifth quarter saw income from this division decrease by 12.5% to 29.4 crores versus the same period last year. As we speak, the mandate is out and we are actively looking for strategic partners to take this business to the next level. Finally, coming to our Railway Products Division. The order inflow from railways continues to remain subdued. Finalization in terms of new orders or tenders has been slow and inconclusive. The order book of rupees 34 crores at the end of September was successfully executed this quarter. At Escorts, we are developing products for new generation rolling stock as we are seeing a decline for the old generation rolling stocks. The Escorts air brake system for the bogie-mounted brakes has been performing well in the field, and the commercial benefits for which will start to appear post-approval in mid-2014. Income for the quarter increased to rupees 33.23 crores, an increase of 20.2% on a year-on-year basis, and a positive swing of 1986 BPS at EBIT level at 4%. Order book for this division as of 1st January stood at rupees 38 crores, which will get executed in the next 2 to 3 months. You can also visit our social media pages for the latest company news and updates. Transcript of the call will also be available on our website later in 3 to 4 days. I will now request the moderator to open the floor for the question and answer session with our management team. Thank you, ladies and gentlemen.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask a question may press star and 1 at this moment. First question is from the line of Basudev Banerjee from Quant Capital. Please go ahead.
Yeah, thanks sir for taking my question. First question is if I see after 3 quarters of continuous downtrend in RM2 sales, what happened this quarter specifically with RM prices more or less being stable? Still it is up almost 330 basis points QOQ. So anything specific in that?
Yes, Mr. Banerjee, you had asked a question. I think we missed you. Could you repeat that question, please?
Yes, sir. After 3 consecutive quarters of better falling raw mat to sales, what happened this quarter that it is up 330 basis points and almost back to the square ones of 72.5 level from which it started falling?
Hi, this is Bharat Madan. See, if you look at the sequential quarter, last time the material cost is shown a dip because we were building inventory for the season months. Now this month we had done that correction of inventory. So as a result, the absorption of overheads in the last quarter was pretty good. We built almost 3,500 tractors in stock, and this quarter we have reduced by about 1,200 tractors. So overall, the impact on the bottom line is almost for 4,500 tractors absorption of overhead. As a result, the material cost has seen an increase. But this is the run rate which we are enjoying. It will remain in the 72 plus range going forward as well.
Okay. Second thing is that if I see your capital employed in ECEL, that has also jumped up quite a lot QOQ, whereas volume traction is more or less in sync with the demand of industry. So is there any working capital issue in ECEL or something else?
No, actually in the capital employed, we were reducing the short-term borrowing. So this time we have paid off the borrowing. So that's why the capital employed is looking at increase. So it's gone down almost by 60 odd crores in this quarter.
And last thing is, and what about tax rate? It's very much volatile. In one quarter, single digit, in one quarter 19%, in one quarter 25%. So what kind of level one should take going ahead?
No, we had given a guidance last time also, because in the last quarter we had done a correction because there was some one-time deduction which we got, and we had given a guidance the rate will remain at 15 to 20% range going forward, and this time it has been about 19.9%, 19.6%, and the similar rate we continue in the next quarter as well.
Sure. And last thing is, sir, we entering the new calendar year and with again harvest season on the anvil in next 3 months' time, how do you see region-wise demand panning out down the line now?
I think right now the south and west is growing much faster than the all India. Or if you have to put it that way, the UP, MP, Rajasthan, Punjab, Haryana are the traditional Hindi belt, we call ourselves as a stronger market. So those markets represent 60%, the rest represents almost 40%. And that 40% of the market of south and west is growing at the rate of 35%. And the northern markets are growing at half this rate. This is what is happening, and we would expect that to continue for one more year.
And any positive or negative impact because of this election? Any comments on that?
Elections in our historically, when we look at our data, perhaps it disrupts almost for 20 to 30 days kind of a time frame. But over a period of 3 months or 6 months, there is no impact on the industry actually. Temporarily it may disturb, maybe from 15th of April to 15th of May. Maybe area of disturbance will happen because the kind of documents customers will be seeking from their village officers and those kind of things are just not, they become inaccessible. They are busy with the election, so the tractor higher purchasing and those periods really suffer, but the customers also adjust themselves, whether they buy little before or little later. So overall effect is nil actually.
And sir, your those farm track Ferrari series exports have started full-fledged?
No, not yet. In other words, we do continue to sell something like whatever we have been doing from India and Europe was already there. But what we are mentioning is we have unveiled a global strategy for our exports in Germany through a new series of tractors called the Farm Track Heritage Series. So those tractors we have unveiled in November. This is getting homologated in Europe. Expected to be available for sales sometime in the month of May onwards.
Okay.
So this is the plan.
Okay. Thanks, sir. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your questions up to 2 per participant. Thank you. Next question is from the line of Mr. Arjun Khanna from Principal Mutual Fund. Please go ahead.
Thank you, gentlemen, for taking my question. So my first question is in terms of the agri business. We've been launching a number of tractors abroad and in India. How do we see our sales growth for the year ahead? And especially if you could talk about the South, sir?
Okay. Okay, I think since we are talking, this strategy is already in public domain. I thought for the benefit of everybody, let me restate it so that they can comprehend in full. The tractor industry generally, I am just giving you a certain classification which is there in public domain. The Tractor Manufacturers Association way of classifying it is what I am giving you. You can classify the tractors up to 30 horsepower contributes to 10% of the market, 30 to 40 horsepower something like a 35% of the market, 41 to 50 horsepower is 50% of the market, over 50% is 5%. This is the way the market is. Within this market, we have already stated the bottom 10% of the market, we do not participate. Means from the level of something like a 3.5%, 4% market share we used to enjoy in those kind of products some 2-3 years back, now almost has become nil. It has become minus 0.5% kind of a type. In other words, the bottom 10 or 11% we are not participating. Reasons are simple, there is no money. Okay, so we do not want to participate on those kind of area. So it is not there. The next big segment what we are speaking about is 31 to 40 horsepower, which contributes something like 35% of the industry. This is a significant segment. Here we do enjoy a market share of something like 14.2% today. Historically, we used to have 20% market share from 4 to 5 years back, and that has come down to something like 14% till last year. It kept on coming down. This is the first quarter where from the fall we are getting into a stagnation phase where we are having something like 14.2% market share. This is one of the big segments. Let me explain that. The farm track, the power track, DS Plus series and Euro series, what we are talking about, is in this kind of a segment. In this segment, this Euro series, what we are launching now, is actually, we should have scheduled it something like 75 days before. There was some technical glitches. We have taken little more time to fix it up, and now it is getting launched countrywide. The good news is, even before launching it, I think we are almost at a marginal positive, and this quarter onwards, perhaps in this segment, we should look at a market share growth. Right. What extent it will happen, only time alone will say. Our own expectation is, for example, from 500 numbers of Euro Plus of last quarter, something like 2,500 numbers of Euro is what we should sell in this quarter. Okay, and this will be a significant quarter for that brand. And going forward, it has a potential to go up to 4,000 kind of a numbers. So this is to give you an idea of what we should look for in Euro kind of a series in 31 to 40 horsepower. Right. Next important category is 41 to 50 horsepower category, which represents something like 50% of the business. And this is the category is predominant in South and West. The South and West does very well in this kind of a category. And here is this category, we lost a market share of almost 1.5%. This is what we have lost in this kind of an area. Now, in this category, we do scheduled some 4 products launched right this month within the Euro series, something called 445. We have 4455. We also have a farm track series. Lot of action is packed up for this kind of a segment. Our idea is from 10.4%, maybe in 2 quarters, maybe quarter 4 or the quarter 2 of the second financial year, we should be back to 12%. Then onwards, we should go back to the original market share, something like a 14% in the next financial year. Okay, and then I will talk about the last segment, which is 50 horsepower and above. This is an image segment, which as per TMA classification represents something like a 5%. And our market share in this segment till 3 years back used to be 1.5%. That 1.5% has already become 3% year before last year, 4% last year, currently 6 year. Maybe 2 quarters down the line, we will be touching anywhere around 8 to 10%. And in this segment, in the quarter 4 of 14, 15, 16, possibly we will be at a 20%. And we are targeting the leadership in those kind of a segment. So the summary is the bottom segments of 10 to 11% we have vacated. We did lost volume there. And as far as it's meaningless to have products without good contribution. The top end image segments, we do target 20% for leadership. We are on our path in the last 3 years. And 2 large segments, 1 segment, Hero series actions are already is implementation. The next segment, the launch is happening in this quarter. Results you will see couple of quarters later. This is a brief summary of how we are approaching the subject. And South and West market should greatly benefit out of this 41 to 50 horsepower series action what we are scheduling.
Right, sir. Just a question. How long before you would actually see traction in the South and West segment, sir?
Okay. See, if I am to answer, I think this already we have stated, South and West, we are almost negligible. With a 3% market share, we cannot count this as a market share at all. We are invisible. People have almost forgotten Escorts in the last 20 years, 25 years now. From that level, our plan is to move the market share to the level of 6% in 2 more quarters. When we say that 3 to 6%, that 6% is more through a segment of our choice. And in our view, in a 3-year program, possibly we should hit even in South also anywhere between 10 to 12% of a market share. And market share of a better segment. And here the realization also will be better. But having said that, right now we need to invest in those kind of a marketing. So that means sales promotion expenditures, we have to incur and apportion for South and West for at least for 4 more quarters.
Right, sir. Just for this quarter, since we did so much of this, would we have seen that in this quarter's numbers where we would have had additional marketing expense?
See, for example, so much of a detail I cannot disclose because I assume everybody.
If there was some one-time element there.
No, it won't be one time. I mean, I have talked about the minimum period expected is 4 quarters.
Sure.
And possibly we are getting prepared for a 3-year action to bring that market into a 12% kind of a market share. But for you, what we can always share is from the level of something like 80 to 100 tractors in Andhra. Now, the first quarter of action has resulted in double this volume.
Wow.
Having said that, double the volume also does not mean much in an industry of 3,500 to 4,000. So we have a long way to go.
Right, sir. So my second question was in terms of the auto ancillary business. You mentioned that you have given out the mandate for a strategic partner. Are we looking at exiting this business? Are we looking at further investment in this business?
No, we are not exiting this business, but certainly looking at strategic partnerships to consolidate and grow.
Right, sir. Sure. Thank you very much.
Thank you. Next question is from the line of Mr. Riken Gopani from Infina Finance. Please go ahead.
Hello. Yeah. Hi, sir. Just 2 questions. One is on the margins, especially on the gross margin side. Is the EBIT margins that you've reported in the agri segment on a Y-on-Y basis are more or less flat now. So since the volume has seen such a strong traction, and we've also taken corrective price moves wherever necessary. So could you highlight as to what would be the factors why the gross margins remain more or less stable on a Y-on-Y basis?
Okay, we can attribute a couple of reasons. Number one is the new product, whatever we have launched now, the benefit what we are expecting now, like the Euro series. What we could sell last quarter was only 500, as against a plan of something like 2,500 for the first full quarter. So I would say that it's close to 1,000 number kind of a benefit we have lost last quarter by the delay in this new product program. The second one is even though we have increased the price, it's not true for the entire industry. And the way the South and West is growing, the overall industry is registering a growth of something like 20%. I would like to estimate in the next 2 to 3 quarters, I think the competitive pressures will start coming down. So that will give you a far better flexibility in terms of pricing. Okay, so we have cleaned up a little more. Pricing possibilities we will explore, certain segment of a choice. All those things should improve our margins. Having said that, we are also getting ourselves prepared for certain actions in South and West so that we have to de-risk ourselves and encash a certain opportunity emerging from those markets.
Okay.
And just to add to that, like I explained earlier, because there was a stock correction which we had done in this quarter. So it will not be right to read only the quarter margin on a standalone basis as the right figure. So if you look at the cumulative YTD margins, they still stand at 10%. So there you're seeing the improvement happening from 8% level to 10%. So that's the rate which we are continuing today.
So just to get more clarity on this, what you have done is this quarter there has been a reduction in the inventory that you have done, which has caused this margin.
Yes, if you look at the SEBI published results, there's a 153 crore stock correction which has happened from last quarter to this quarter, the variance we're saying.
Okay.
Which is essentially because of absorption of overhead which went to last quarter, but sale happened in this quarter. So there's a gap of production and sale numbers basically. So inventory correction has happened in this quarter. So going forward, when your production sale numbers are same, so that variance won't be visible. So the run rate will still remain same at about 10%.
Okay. And the second question is more in terms of the growth outlook that we had said in the last quarter that you were looking at some slowdown post Q5 numbers in terms of growth rate. What is your outlook as of now from whatever you read into the markets? We hear from some of the companies that rural markets are actually decelerating in terms of growth. Anything that you would like to highlight? What should be the trend like for the next 2-3 quarters in terms of growth?
But we do not read it that way. We do not have any reasons to expect a deceleration. I think the growth signs started happening at from April-June quarter last year. So that means 3 quarters consecutively we are seeing a better growth rate, and we do not expect the growth rates to come down. I think we should expect this quarter also to the level of something like close to 18%, maybe a possibility. I think at least 14% kind of types are definitely seen for next full financial year. Those kind of a visibility is there, unless otherwise something grossly going wrong which is beyond our comprehension we cannot see. But as of now, 14% is a good possibility for even next financial year.
Okay, 14% for FY15 and about 18% for the next quarter is something that looks quite achievable.
This quarter.
Yeah, Q6 which is what.
Yes, correct.
Right? Okay. Thank you, sir. That's it from my side.
Thank you. Next question is from the line of Mr. Vinay Nair from Rare Enterprises. Please go ahead.
Hello.
Hello, Vinay.
Yeah, hi. Mr. Sridhar, I just wanted a clarification. This 18% is for the current quarter, right? The 6th quarter?
Of course, yes.
Yeah. Secondly, in one of the previous questions to Mr. Madan on the capital employed, he had given an answer. I'm not very clear on what exactly are the reasons for the increase in the capital employed. Can you please explain it again?
In the capital employed in the current liabilities, we are including the short-term borrowing also. If you look at the balance sheet which gets published every 6 months in the results, so there we are also including the short-term borrowings. So this time the borrowings have been paid off. So which is why the current liabilities have gone down. As a result, the capital employed has gone up for EC.
Okay, sir. Thank you. That was my question.
Sure.
Thank you. Next question is from the line of Mr. Sachin Kasera from Lucky Investments. Please go ahead.
Yeah, hi, sir. Sir, my earlier investor conference, my question is to Mr. Madan. You did explain to us that over a longer period, we are about 300 to 400 basis point higher than the competition in terms of raw mat to sales, and about 300 to 400 basis point higher than the competition in terms of employee costs. Where we seem to be fairly doing well on the employee front, but our raw mat to sales is yet not reflecting that kind of confidence. So can you throw light on that number? And also, sir, to Mr. Sridhar, I mean, what gives you this kind of confidence that you will be able to gain market share when you are fighting against M&M and rest of the other players? Because typically what we have seen in the industry is that the market share gains are not very, very easy, but market share loss is very, very easy. So just wanted to get your understanding on this particular this point.
Okay. I'll just tell you our own philosophies here. See, overall market share does not mean anything for us. Possibly the similar thing you will be hearing from a Honda CEO in one of the interviews I was reading it. But what is most important is the segment of our choice, where we wanted to participate, where we are putting in our action plan is very, very important. This is where I have explained. For example, that up to 20 horsepower category is growing, where we are not showing much of an interest. We have an outsourced program but not participating because there is no money. Even to 20 to 30 horsepower also is contributing something like 8% of the industry. There also perhaps from a 3.5-4% market share, we have almost become zero market share because we are vacating it. The reason for my quoting this is all these things will have an impact on the overall market share. And it's very, very important for us to clean up ourselves so that we sharply focus on the brand the way we wanted to focus. Now, having said that, there are only 3 categories we are talking about. The first category, the image category. I'm just restating it so that the image category of over 50 horsepower, if you look at it last 3 years, our market share is continuously up from a level of 1.5% in 10-11, 3% in 11-12, 4% in 12-13, and in this quarter we are 6%. And couple of quarters down the line, it would have been anywhere around 8% minimum to 10%. This itself is a very steep journey. From something like a 1.5% market share, we are talking about a 10% market share in 3 years. And this 10% in another 1.5 years is expected to be at 20%. This is where even our collaboration with companies like Porsche Design, very many alliances what we have already tied up, projects are halfway through, all targeted. The share what I am talking about is even before we release that world-class products through those kind of collaboration. This is to tell you that we are well on our way to become an image leader. The programs are firmly in place. Okay. Now, the second category what we are talking about is, even though the TMA kind of a report only publishes 41 to 50, the way we subject ourselves is 45 to 50 category, which we call it as a E category. In this kind of a category, we used to enjoy a market share of something like 18 to 20% even already, couple of years back, which also came down to something like, the 16% now. This fall is mainly because of the South and West phenomena. We are not present, and those markets, for example, Maharashtra has got over 60% of the market is on this kind of a segment. Okay. And the product, whatever we are putting in right now, I talked about 3 different products are getting launched, like PT Power Track 445 and also the 4455. That's a Farm Track series, executive series. All the products are launched in this category of 45 to 50 and above. These products together, in our hope, should move the market share from 16 to 20% in over a period of 2 years. Definitely 2% all India, but the South and West should increase this market share something like a 3% to 6% to 7% time. This is what our plan is. As long as we are focused on the kind of a product, and all our products, some of this product like a C category, whatever I said, our pricing is on the top 1/3 percentile in terms of pricing. In other words, our pricing is not on the bottom. If I were to just give you products like Suraj and Eicher are on the bottom 1/3 of the percentile, Mahindra kind of a company may be in the middle. We are on the top 1/3 percentile in terms of pricing. Even with that pricing, we are moving our market share to 14.2%. So there are evidences. What it may be perplexing is when you look at the overall market share and decline, it may be looking that we are losing, but we will be consolidating on the segment of our choice, market of our choice. Should happen. But finally, if it doesn't happen, really doesn't matter. As we said, I think more and more we will become governed by the bottom line rather than on the top line actually.
And just to address the questions on the financials, the manpower cost, as you said, we have been able to put it on hold. So as of now, if you look at the numbers for this quarter versus last year, we are virtually at the same cost, in spite of all the settlement with the union happening and all the increments being given. On the material cost, there are two things which you need to look at. One is the top line. It's a percentage we are saying. The percentage, there are two, numerator and denominator management. So on the revenue side, like Mr. Sridhar talked about, we are moving towards the product mix, which will be towards the higher end products, the premium products, so the revenue will go up. On the material cost, we have taken action, but on the material front, typically it takes longer time to really get them implemented and bring it onto the books. So the efforts are on, so the reduction is on plan, and we are working on that. So you will see gradual reduction happening on that cost front going forward. As of now, we continue to be at 72% on tractor business.
So can you give us a roadmap over 2 years in terms of material cost?
Yeah, that's right.
Over 2 years, can you give us a roadmap in terms of material cost? Where would you like to be?
See, we're seeing the best in the industry. We are benchmarking. There's a gap of about 4% today. And we are aiming to capture at least 50% of that in next 2 years' time.
Next 2 years, 50% or 4%. Okay. Sir, what is the total debt?
We are at about 400 odd crores, 413 or 415 crores by end of December.
This number is kind of likely to plateau or
it will continue to be in this range. So we said like term debt, we are raising debt for the capex program and we are also repaying, which will be more or less neutralizing each other. Okay. Working capital is a temporary cycle. If we are in season, it will go down. Like June quarter will go down, but again, September, December quarter, it goes up. Right. So average basis, it will continue to be in that range.
So sir, where will you use your cash flow?
As of now, like I said, we have repaid the loans. We reduced our working capital in this quarter. So if you compare with the last year, we reduced our borrowing by almost 100 crores. You see the reduction in interest cost happening. It's gone down by almost 6 crores.
Right.
So there is working capital opportunities. As and when the cash flow is surplus, we will obviously pocket and reduce the debt.
Okay. And sir, in terms of capex, so you said you want to use money for capex. So this is what capex?
This is the product-related capex which you're doing.
Okay. So capex will typically go in the balance sheet or in the P&L?
In the balance sheet.
In the balance sheet. How much every year?
It's roughly 80 to 90 crores a year.
80 to 90. Okay, great, sir. Thank you very much.
Thank you. It's a reminder to all the participants. We request you to limit your questions up to 1 or 2 per participant. Thank you. Next question is from the line of Mr. Akshora from Praj Investments. Please go ahead.
Yes, sir. I just wanted a clarification. You mentioned that from 41 to 50 horsepower contributes 50%. That is for Escorts or Ola or industry?
This is for industry.
This is for industry, right, sir?
Yes.
And one more thing, sir. You mentioned that in 50 and above horsepower category, we're aiming around, right now it is, market share is around, we are aiming to have market share around 20%. So where will be the demand coming from? Mainly from South region or in India or from exports, sir?
No, exports is separate. This, what we are talking about is in this category of the products also goes to exports. The entire European series, what we launched is in this kind of a category. This kind of a category emerges in South, West, evolved markets like Punjab, Haryana. These are all the markets which are predominant on this, over 50 horsepower.
So mainly we are aiming market share expanding in South around 12% next 2 years would be mainly coming from 50 and above horsepower?
It will come from something like, I would say that from 45 to 50 horsepower, action will happen on 45 to 50 and 50 and above. This will be predominant products.
Okay. And lastly, sir, one more clarification. You had said that for FY14, we'll be able to grow around 10 to 15% for full 18 months. So that would be for tractor division or for the company as a whole?
See, this I have not spoken about Escorts. This I spoke about industry and industry, tractor industry.
Okay. The tractor industry will be growing at 10 to 15%, right?
That's it.
Okay. And so lastly, our margins in tractor division came slightly below the expectation. So would it be able to sustain, or will it be in about 10% level, sir?
See, we talked about an targeted EBITDA of something like a 15% as a part of a 3-year program.
Yes, sir.
And we also was Mr. Madan has already explained that we are almost at a 10% level.
Yes, sir.
So we are very much on our path.
Yes, sir. I just wanted to know that will it be maintained for next 2-3 quarters about 10%, or it will be below 10%? Just wanted to know.
Likely to be maintained.
Okay, sir. Thanks a lot.
Thank you. Participants are requested to limit their questions up to 1 or 2 per participant. Next question is from the line of Mr. Hardik Doshi from First Voyager. Please go ahead.
Hi. I just wanted to, follow up a bit on your commentary on overall demand, expecting tractors to grow by about 14% next year. We just wanted to tally that with, Mahindra Finance in the recent conference call was saying that in the West, at least in MP and Maharashtra, they were seeing a little bit of weakness in the near term because of delay in paddy price and soybean, prices being firmed up, and also in the south they were seeing an increase in delinquencies. I know your market share out here is small, but can you just give any sense of, are you seeing any kind of stress levels at all in your markets out there?
See, in fact, we do not share their view that price, for example, what they are talking about, the crop prices, whatever they are talking about, delay. See, the growth and what exactly we have been happening, we do not have a direct correlation at all. It has been already growing. If you look at it in the last few quarters, the growth rates are very, very high. Okay, it's something like a 22 to 25%. So the next time what will happen is the growth rate will get moderated. It will be moderated in our estimate is something like a 12 to 16%. That's why an average rate what we are taking it as 14%. We do not see anything abnormal. For example, overall conditions were much better. Quality of monsoon was much better. Crop quality is much better. Outputs should happen. In addition, when the second season, a second better season over the first season, generally keeps that momentum going. Already people are in a good sentiment as far as the rural folks are concerned. When fundamentally there is nothing wrong, like the way with monsoon or crop prices, nothing is deteriorating. We do not see any negative things to happen to dampen those kind of stuff. So that is anywhere around 12% to 16% is the kind of a band we would like to take.
Okay. And anything in Andhra, related to there was a little bit of weather disturbance in the third quarter. Any impact that had on the agri output and demand environment there?
As I said, that we are too small in Andhra, but overall on the industry we do not see any impact.
Okay. Got it. Thank you.
Thank you. Next question is from the line of Mr. Ajay Sethia from Centrum Broking. Please go ahead.
Good morning, sir. Thanks for taking my question. Just wanted to understand on the industry side, how are you seeing the supply side coming through from most of the players, and how is the demand supply? And second, what would be the industry in terms of the utilization rates?
I think as of now there is nothing called a short supply. I think there is enough capacity.
I was more referring to oversupply, which is likely to come. I mean, got players sort of adding capacities. So.
No, I think nobody has added capacity in the last 1 or 2 years.
Okay.
When industry was a flat, almost 0% growth for the 2 full year, I think nobody has added their capacity. But having said that, the industry has enough capacity so far. So there is neither short supply, nor the kind of a demand what it is going to happen, it will ease them out. That is where I said the competitive pressures are expected to come down in the next 3 or 4 quarters actually.
Okay. And so second thing, within the south market, Tamil Nadu as a pocket has seen a degrowth of almost 45 to 50%. And there was an expectation that from Jan onwards, TN would pick up. Any signs which you are looking or gathering from the marketing guys over there?
No, because Tamil Nadu again is we are non-existent.
Okay.
Tamil Nadu and Kerala together, I think, has suffered out of a very bad, what you call the northeast monsoon. So there is a monsoon failure resulted in certain problem. And generally, Tamil Nadu is also considered as, slowly it's becoming a non-agrarian state.
Okay.
So the industry size is also becoming marginal. Really, for us, it really doesn't matter. We are out of Tamil Nadu. We are very small.
Right. And sir, how's the trend sort of moving on the non-agri usage of tractors? Maybe if you can just take us through for the last 2 or 3 years, what sort of trend you are looking at?
See, the non-agri usage of tractors happens more with the resale tractors. It's trade-in tractors.
Okay.
Just 50% of the purchasers, he gives the older tractor and buys the new tractors. And that older tractors are sold to those kind of haulage purposes.
Okay.
And the haulage activities have considerably come down in the last 2 years.
Right.
Because of that, the resale value also has come down. So there was this is one of the sufferings. But in that area, we do not see any recovery yet.
Okay.
So while agricultural activities are positive, those areas are not much. But I would assume that in another 1 or 2 quarters, even those areas also will start seeing a recovery. When that recovery happens, resale value becomes better, and that really helps the industry to further grow. These are the areas which will differentiate what will happen between 12% industry growth to 16% industry growth.
Okay. Fair enough. So just last question, what would be the inventory levels for the industry? Would it be in the comfortable zone given the fact that the demand is quite strong?
Yeah, of course, this is reasonable. We do not have any reasons to believe that anybody has excess stocks.
Okay, fine. Great. Thank you so much, sir.
Thank you. Next question is from the line of Mr. Viraj Kasharia from Security Investment Management. Please go ahead.
Thank you for taking my questions. I have 2 questions. First one on the Ferrari tractors you launched in the sub-20 segment. So how's been the response so far, and what are your thoughts on on that particular product?
See, the Ferrari as it is today is a niche product. We have already said that 100 tractors in a year we will consider as a very big number. I think we are somewhere around 48 to 50 numbers is what we have sold so far. And the current pricing of that product is, for example, a matching product like a Kubota maybe at 4.5 lakhs, and this is something like 8 lakhs. It's pretty expensive. So the idea behind those kind of products is one is enhancing the imagery, and also we are exploring the possibilities of selective localization to bring down the cost. So there is a discussion going on between our R&D team and Ferrari Europe. So as and when there are developments, I think we will share it with you.
But you did have some plans to launch something in the 20 or 22 HP segment, more Ferrari tractor.
Ferrari tractor is already 24 horsepower, but it's a pretty expensive tractor. This is something like 8 lakhs odd. It is not a cheaper tractor. It's not like a 2 lakh category of, say like Mahindra Yuvraj. This is 4 times expensive than those kind of tractors. But we are doing something, some localization we are attempting. All these things are too early to discuss, but these things are required more in terms of a long-term outlook. Means 3 years from now, these kind of segments will become very, very significant. So actions are put in place more keeping in view of future.
And why are you saying we were a very big segment? Because as you said, rightly pointed out, the price differential is pretty big. Say 2 lakhs versus 8 lakhs. Even if you recognize the difference may still be a big factor for any farmer to go for Mahindra or Yuvraj vis-a-vis Ferrari. So, what's the thought process?
See, the idea is not about money. It's not about 2 lakhs versus 8 lakhs. For example, 2 lakhs tractor is bought by the guy who is really poor, 1 or 2 acre guy. The 8 lakhs tractor is bought by the exporter of grapes actually. So the profile of the customer is very, very different. But when we say this kind of segments are impacted because the compact tractor as a segment in India is yet to emerge. It will emerge. Okay, what we have is a utility range. The whole of the industry operates on a utility range. So this kind of an area we needed to make a beginning. So we are making a beginning. But I would like to leave it that way. This has a lot of strategic implication on what we call internally a 2020 plan. For those kind of plans, the Ferrari will have a very important play. But not on the immediate quarter and immediate year.
Okay, and just one more question was on the, just want to get your view on the, possible, how you look at the other agri machineries, like you have tillers, you have rice transplanters. What is the long-term view, medium to long-term view in terms of how you view those segments and whether Escorts is looking to venture into those space as well?
See, there is a huge opportunity. I need not even mention that. Everybody understands, and the world has gone very, very in an advanced stage. We are just scratching the surface. But having said that, there are a couple of decisions we have taken. We are shortlisting equipment. Trial operations are on. It's almost 1.5 years we are into those kind of studies. But we will not be manufacturing those kind of equipments which does not give us a very good margin and very good scale. So we will be outsourcing those kind of implements, and which agency will do what, I think possibly we will be in a position to share in 1 quarter down the line. So serious evaluation is going on those kind of areas.
Okay, but any particular product segment you're looking to target first vis-a-vis others, or?
No, that I think I should not disclose right now. Let me do this, and then maybe the next con call we will be in a position to share something else.
Okay, fine. Thank you. That's all from my end.
Thank you. Next question is from the line of Mr. Kaushik Poddar from KB Capital Markets. Please go ahead.
Can you speak something about the railway products?
Railway products, actually, if you see this particular quarter, which ended in December, the top line was a little bit down because there were few big tenders which were still to be concluded, particularly the wagon tenders, which we are a big supplier of components. The whole of the wagon industry for the almost 1 to 1.5 years, we did not have any orders coming out for the railway board. We expect that now with the joining of the member mechanical and the chairman railway board, we should be having some new tenders coming out, which would also give us a significant amount of business. And we have recently launched a few products which are into validation mode, which should be there available for us to commercialize by the July-August time frame of 2014. So that would be a big impetus for us.
I mean, what is the kind of growth you're looking, say, next year?
Next year we are looking at least 20% growth.
20% growth, and your overheads and all these things will remain same, or that will also?
We are also working on our fixed cost, and we hope to reduce our fixed cost quite a bit.
Okay then. Thank you. Thank you.
Thank you. Next question is from the line of Mr. Sunil Jain from Nirmal Bang Securities. Please go ahead.
Yeah. Good afternoon, sir. This is more related to auto ancillary products. No doubt the revenue came down along with the industry, but the losses seems to be mounting. On a revenue of 29 crore, we are incurring a loss of 9 crores. So what is the reason behind that, and how we are taking up this? No doubt you are coming up with, you're trying for some tie-up and all. But till that happen, what type of measures we are looking in it?
We are looking at, that actions are already on to reduce the fixed costs and convert some of them into variable costs, so that we are better prepared to take the industry downturns or volume downturns which happen in the auto industry. So that actions are on, and in the coming quarters, I think the results of that would be visible.
But was there any extraordinary in this 9 crores EBIT loss?
No, our fixed costs on an absolute basis did go up because of manpower costs going up, and that is something that is being worked upon and brought down.
So the key reason for the continuous loss in this particular division is manpower only, or is something else?
It's both. It's a volume drop, which you see, which is significant, plus the manpower cost, which is there. And obviously, there is another reason is the product mix, which was not really comparable to what we had in the last year. So that has also gone down because of the bottom line has been impacted adversely.
Okay. And sir, apart from this, in construction equipment, we are seeing some uptick in volume also and plus revenue also. So can you throw some light how this is likely to move in the coming period?
The construction industry continues to be policy driven, and we have seen a significant drop in the industry as the quarters are moving ahead. And one of the things that you see the number of equipment being sold on a unit terms is probably we are growing better than the industry fall. That means we are keeping our market shares intact, and in some of our prime products like backhoe loaders, our Big Max 2 market shares have gone up, and in spite of the downturn, and that means that gave us the product mix, and focusing on the core product has given us this volume. The volumes being growing. The profitability portion of it came probably between cost optimization from our end and also price increases and price realization.
Yeah, but any outlook on the coming period, since you are going against the industry, means you are growing better than industry.
Yes.
So any steps you might have taken to sell your product more in the market, and which may be driving all these things. So any outlook on that?
When we look at our product range, almost all our products have seen a downturn, and one product that continues to be very stable is the backhoe loader business. And so we are focusing very seriously on retaining the backhoe loader market with us. We are very, very small player there, but we are increasing our market share significantly. Today we can say that we reached a market share of something like 5%. And we are focusing on that, and we look forward to continuing focus on that and drive that business. And coming to the forecast, I would be very reserved, and we are looking at that this current situation will continue for at least next 2 quarters.
Okay. Great, sir. Thank you very much.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question from the participant. I would now hand over the conference back to the management for their closing remarks. Thank you, and over to you, sir.
Ladies and gentlemen, as usual, once again, it's been a pleasure talking to you. And we do thank you for sparing your time and being with us at this con call. We at Escorts very strongly believe in our core values, not only respect for our own individual internal team members, but respect for our investors, our stakeholders. Empowerment, transparency, and collaboration come up in the next areas of our core values. We do our business on the basis of this, on the basis of these beliefs, and we look forward to once again having and sharing our thoughts with you at our next quarterly investor call. Ladies and gentlemen, thank you so very much.
Thank you. On behalf of Escorts Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.